Now go across to Manishi Raychaudhuri of BNP Paribas, who's joining us live today. Good morning. Earnings season is officially here. I'll get to that in a bit, but the other big trigger, we saw FII sell what, 1.4 lakh crores worth of equities last financial year. So far in April, they've turned out to be net buyers. It's a market now which is dominated by domestic institutional investors. It's a DII market. But Manishi Raychaudhuri, the turn that we're seeing when it comes from FIIs, if you look at the April data, what do you make of it? Is there change on ground? Are you telling your clients, for example, as well the same?
It's too early to conclude that this is a change of stance on the part of the FIIs. FII selling in India, and it's not just India, but across emerging markets, started from around October. It's continued till date, and it was triggered basically by two drivers. Number one, we had the Fed stance changing quite rapidly during the last quarter of 2021 in terms of monetary policy normalization, or the pace of monetary policy normalization. And second, the conflict in Europe obviously pushed up energy prices and various other food products and other commodity prices, impacting the current accounts of many emerging markets, including India. And that obviously led to a concern about emerging market currencies. So, these two drivers are not yet behind us. In fact, I would point out that while the Fed rate hikes are kind of digested, at least the narrative has been digested by emerging markets. But the fact that Fed is now going to enter into a quantitative tightening phase from around May, I don't think that is digested adequately. So I would, in a nutshell, recommend that investors remain cautious about FII flows in the near term. Honestly, I don't think we have seen the full extent of FII selling in emerging markets yet.
Exactly a month ago, when we hosted you on this very show, you said buying anything right now is like standing in front of a running train. Has that at least changed?
Yes, I do remember that phrase. Some of and as I said just now, that some of those drivers at that point of time, including the military conflict in Eastern Europe or the Fed's rapid change in stance as far as monetary policy normalization pace is concerned, those things are still with us. In fact, if one looks at the most recent FOMC meeting minutes, one would see that there's a clear reference to QT, quantitative tightening, possibly up to a maximum of $95 billion per month. And this is likely to be far sharper than the previous round of QT that we had seen. If you look at the 2017 to 2019 episode, we had seen the total FII selling in Asia to the tune of possibly around 0.7 to 1% of the market cap of the Asian markets. And compared to that occasion, this time around, the QT is likely to be sharper. It is also happening at a time when the rates are likely to be hiked simultaneously. So, while the situation may not appear as dire as when I had made that comment about a month ago, caution, I would say, is still warranted.
Sure. Manishi, can't help but talk about what's happening within the FMCG space. I mean, sleeping giants like ITC are sitting at a fresh 52-week high, and now you can actually buy a piece of Patanjali, via Ruchi Soya FPO when the shares got listed. Wanted to understand how is it that you're, scouting opportunities within FMCG at a time when we all know what's transpired with inflation and input cost pressures?
In general, we are very positive on the consumer space at this point of time. If one looks at the consumer staples and consumer discretionaries taken together, we're only focusing on those stocks which are, the market leaders and distribution leaders in their niches, and therefore They are the ones who are able to pass on the input cost hikes to their customers. So I think in the entire consumer space, in the face of continuing input cost pressures, investors would have to be very cautious. It's a lot easier, possibly a lot more advisable to play these input cost or the input manufacturers, in a sense, energy or materials, for the time being at least.
That's quite interesting. Manishi, where is it that you feel that the exuberance is now overdone and you would actually want to lighten your positions or avoid some sectors, if at all?
One example I gave, consumer orientated sectors, maybe more expensive consumer staples, consumer discretionaries, because we must remember that increase in cost of capital tends to reduce the valuations that expensive stocks tend to trade at. And obviously, we have seen part of that happening where the growth stocks have derated. But we think that as a consequence of the likelihood of capital cost of capital going up even more, that process is likely to continue for some time longer. So, number one, avoid expensive stocks, particularly the ones that don't have pricing power. I would also point out that in the face of these energy costs rising, we're not too positive on the marketing and refining space. We would rather play the explorers here. So those are the two clear examples of sectors that we're staying away that come to my mind.
I would want to understand what the outlook is as well, in light of what you spoke of, some of these concerns, as well as the fact that there's this, ongoing global tensions, the lockdown in China, straining supply chains for the auto sector as a whole. How are you looking at this, given that some of the corporates as well have openly acknowledged the semiconductor shortage as well, plaguing their overall operations?
Here again, as I said, one has to be very careful in the auto sector, particularly the companies that have clearly voiced their opinion about about the supply chain disruption affecting their production. That would pretty much fit many companies, but the ones which are predominantly concerned with the domestic market and the ones which have a relatively low import content in their input mix, they are the ones which would be relatively resilient at this point of time. So basically, we're looking for three criteria. Number one, the input mix, which we would obviously prefer that to be relatively onshore focused. We're also looking at the market position of the company in their respective niche. And therefore, these two things we believe would enable that company to pass on the cost hikes to their customers. It's not an easy game at this point of time, as far as that entire gamut of consumer discretionary and consumer staples are concerned.
There's a report this morning on the telecom space in India saying that growth in the upcoming quarter will largely be led by ARPU growth on account of the full benefit of the tariff hikes, while subscribers are likely to remain under pressure on the back of SIM consolidation. What's your sense when it comes to the telecom space?
We tend to agree with that. In fact, we like the telecom space, both the pure plays and the conglomerates participating in that space. We think that as a consequence of the consolidation that we have seen, ARPUs have been increasing and they're likely to continue to do so for the foreseeable time horizon. So we do have significant exposure to the telecom space across Asia and particularly in India.
Manishi Raychaudhuri, we're talking on the morning of the earnings season kicking off here in India. IT bellwether TCS will, of course, be doing that. Your expectations from this season's earnings season, the trends will be similar, margins being squeezed out. But the chatter now is, will we see earnings downgrades beginning from this quarter that will be under review?
There are a few sectors where we have already seen earnings downgrades, and they pertain largely to the consumption and the commodity user space. So consumer staples, some consumer discretionary selectively, some of the industrials, they have already seen consensus EPS estimate downgrades over the past 1 to 3 months. We would expect that to continue in this quarter as well. The sectors that should do better and which have already seen earnings estimates move up are possibly IT services. We have seen some of the banks facing earnings estimate downgrades over the past 3 months, but I think there could be some recovery in the banks, particularly the private sector banks' earnings estimates going forward. As yields rise, the net interest margin tends to improve. We have already seen that in the developed Asia universe, and it's likely to sort of cascade down to India as well. So it'll be a mixed bag. I think IT services should be fine. The financials selectively should be okay. It's the consumers and other commodity users that I would be cautious about.
Okay, so let's talk a little more of that. You began the interview by talking about the fact the markets are not completely and fully priced in normalization by central banks. So as that happens, and we still figure out whether inflation is structural or transient, it is very real. Are you folks changing your entire strategy when it comes to the commodity packs, with base metals in particular?
Well, not really. I mean, as far as the commodity exposures that we have in our Asian model portfolio, we do like the energy explorer space. We have selective exposures in other materials, though more so in Southeast Asia than in India. And those positions are unlikely to change in the foreseeable time horizon. We think that commodity prices shall remain, buoyant for the time being. Much of the drivers of these commodity price spikes that we have seen, which are enhanced demand in the developed markets and the geopolitical tensions, are unlikely to be resolved anytime soon. So we are clearly maintaining our positions in these sectors for now.
Right. Manishi, we're also speaking for the first time after the amalgamation of HDFC Bank. I mean, same time last week, we were all going, covering this news all out, and the creation of the behemoth. Wanted to understand what is it that you now feel about the HDFC conglomerate and what it means for the other fintech/NBFC players out there who are going to now compete with this large entity.
Well, I can't comment on specific instances or specific companies. But in general, consolidation and therefore a relatively lower cost of capital for the consolidated entity is likely to become the order of the day going forward. We've seen that in the Indian banking space. This degree of consolidation and therefore increase in size by inorganic means. And we think that this is likely to continue further. Now, obviously, some instances of consolidation are giving rise to entities which are way larger than what we have seen previously, and and this is something we have to prepare for. It means that not only could the cost of capital for some of these entities decline, but also their pricing power and therefore their return on equity and the return on capital that they generate going forward could actually be boosted.
Manishi, let's also understand it's not a very talked about space, but it's been hot of late for sure. That's been the media sector, be it the consolidation that we've witnessed with the huge multiplexes. There's going to be IPL bidding on the annual sponsorship, rather. And you've also got the ad revenue growth, which is back on track after a long lull. What's the sense that you're getting within the media space, and which are, the subsectors that you'd be bullish on?
Over the longer term, we do like the media space for pretty much the reasons that you pointed out. Ad revenue growth, a sharp economic recovery from the previous year's COVID lows, which has obviously led to this buoyancy in the revenues of the media companies. In the near term, it's the pressure on margins of the consumer companies, which are the bulk of the contributors to this ad revenue growth. That is what makes us a bit cautious. So I think, over the next 1 to 2 quarters, one would have to be a bit selective about the media companies. Over the longer term, they broadly look fine, though I would be avoiding the really highly valued or the more expensive exposures in this space. And there are quite a few of them.
Pleasure chatting with you. Thanks very much for joining in. You've given us a view on pretty much all of the sectors as well as your outlook on the markets.